The market roller coaster, a wild ride. Investing in the stock market can be one of the most thrilling experiences, akin to riding a roller coaster. The highs can be exhilarating, and the lows can be terrifying. But just like a roller coaster, the key is to stay strapped in and enjoy the ride, knowing that ups and downs are part of the journey. Investing can feel like a roller coaster. The market's unpredictable nature can make even the most seasoned investors feel a rush of adrenaline. One moment you're on top of the world watching your investments grow. The next, you're plummeting, wondering if you'll ever recover. It's a wild ride, but it's also an opportunity to learn and grow. Prices go up, prices go down. This is the nature of the market. It's a living, breathing entity that reacts to countless factors, from global events to individual company performance. Understanding this can help you stay calm during the inevitable fluctuations. It's easy to get caught up in the excitement when things are good. When the market is on an upswing, it's natural to feel optimistic and confident. You might find yourself checking your portfolio more often, reveling in the gains. But it's important to remember that what goes up can come down. It's even easier to panic when the market takes a downturn. Market volatility is normal. During these times, fear and uncertainty can take over, leading to hasty decisions that might not be in your best interest. It's crucial to keep a level head and remember that downturns are a natural part of the market cycle. It's important to remember that. Staying calm and composed during market volatility can make a significant difference in your investment journey. Instead of reacting impulsively, take a step back and assess the situation with a clear mind. Don't let the ups and downs scare you away from investing. The market's fluctuations are not a sign to abandon ship, but rather an opportunity to reassess and strategize. Long-term success in investing often comes from staying the course and not being swayed by short-term volatility. Instead of fearing volatility, learn to navigate it. Educate yourself about market trends, historical data, and investment strategies. Knowledge is power, and the more you understand the market, the better equipped you'll be to handle its ups and downs. Understanding the basics can help you make smart decisions. Whether it's learning about different types of investments, understanding risk tolerance, or knowing when to buy and sell, a solid foundation in investing principles can guide you through the market's turbulence. This is true whether you're just starting out or have been investing for a while. No matter your experience level, the market will always present challenges and opportunities. Embrace the journey, stay informed, and remember that every investor, no matter how seasoned, was once a beginner. The key is to keep learning and growing, turning each wild ride into a valuable lesson. Tariffs and dips, recent market shakes. The financial world has been buzzing with activity lately, and not all of it has been positive. Investors and analysts alike have been on edge, watching the markets closely as they react to various economic events. One of the most significant factors contributing to this recent turbulence has been the announcement of new tariffs. These tariffs have sent ripples through the market, causing a noticeable dip in stock prices, and creating a sense of uncertainty among investors. Remember those tariff announcements a few weeks back? They were a major talking point in the financial news, with experts weighing in on the potential impacts. The press conferences and news broadcasts were filled with speculation and analysis, as everyone tried to predict how these new tariffs would affect the global economy. The immediate reaction was a drop in stock prices, as investors feared the potential for increased costs and reduced profits for companies affected by the tariffs. Yeah, those caused a bit of a stir in the market. Traders on the stock exchange floor were visibly shaken, reacting to the news with a mix of surprise and concern. Financial analysts quickly began discussing the potential long-term impacts, debating whether this was just a temporary blip or the start of a more significant downturn. The stock ticker showed increased volatility, with prices fluctuating wildly as the market tried to find its footing. We saw a dip, a little wobble, and everyone started to worry. The charts showed a clear downward trend, and the mood among investors was one of caution and concern. Many were glued to their screens, watching the numbers closely and trying to decide whether to hold their positions or sell off their stocks to avoid further losses. The trading floors were busier than usual, with traders scrambling to make sense of the rapidly changing situation. This is a perfect example of market volatility in action. Volatility is a natural part of the stock market, and it can be driven by a wide range of factors, from economic data releases to geopolitical events. In this case, the new tariffs were the catalyst, but the underlying market dynamics are always at play. Financial analysts often use these periods of volatility to study market trends and make predictions about future movements. For investors, it's a reminder of the importance of staying informed and being prepared for sudden changes. External factors like trade agreements can impact stock prices. Trade agreements, tariffs, and other economic policies can have a significant influence on the market. When countries negotiate new trade deals or impose tariffs, it can affect the profitability of companies that rely on international trade. Investors need to pay attention to these developments, as they can create both risks and opportunities. Understanding the broader economic context is crucial for making informed investment decisions. It's important to remember that these events are often temporary. While market volatility can be unsettling, it's usually short-lived. Economic policies and trade agreements can change, and markets tend to stabilize over time. Patience is a valuable trait for investors, as reacting impulsively to short-term events can lead to poor decisions. By keeping a long-term perspective, investors can ride out the ups and downs and avoid making hasty moves that could harm their portfolios. Don't panic and sell your investments at a loss. Ride out the storm. The market usually recovers. When faced with market turbulence, it's natural to feel anxious, but selling off investments in a panic can lock in losses and prevent you from benefiting from future recoveries. Instead, take a step back, review your portfolio, and consider whether your investments are still aligned with your long-term goals. Consulting with a financial advisor can also provide reassurance and help you stay on track. Remember, long-term thinking is key. Successful investing requires patience and a focus on the bigger picture. While short-term market movements can be unpredictable, the overall trend of the stock market has historically been upward. By maintaining a long-term perspective and staying committed to your investment strategy, you can navigate through periods of volatility and work towards achieving your financial goals. So, keep calm, stay informed, and trust in the power of long-term growth. Keeping your cool advice from the Finfluencers. In the world of investing, emotions can often get the best of us. It's crucial to stay grounded and not let fear dictate your financial decisions. It's easy to get caught up in the frenzy when the market goes haywire. The flashing numbers, the constant updates, and the overwhelming amount of information can make anyone feel anxious. But remember, the market has its ups and downs, and this is just a part of the cycle. Everyone's talking about it, the news is full of doom and gloom, and you just want to sell everything before you lose it all, right? Wrong. This is the time to stay calm and collected. Panic selling can lead to significant losses and missed opportunities for recovery. My friend Bola, Sokunbi, the brilliant mind behind Clever Girl Finances, always says, investing is a marathon, not a sprint. And she's absolutely right. Long-term investing requires patience and a steady hand. It's about weathering the storms and staying the course even when things look bleak. Don't make rash decisions based on fear. Take a deep breath. Remember your long-term goals. This too shall pass. It's essential to have a well-thought-out financial plan and stick to it. Regularly review your investments, but don't let short-term market fluctuations derail your strategy. Trust in the process and give your investments time to grow. Seek advice from trusted financial advisors and do your own research. Educate yourself about the market trends and understand the fundamentals of investing. Knowledge is power, and the more informed you are, the better decisions you can make. There are plenty of resources available, from books to online courses and webinars. Take advantage of these tools to build your financial literacy. The more you know, the less likely you are to make impulsive decisions based on fear or misinformation. Set clear financial goals and create a vision for your future. Having a roadmap can help you stay focused and motivated even during turbulent times. Write down your goals and revisit them regularly to remind yourself of the bigger picture. Celebrate your financial milestones, no matter how small. Each step forward is progress and brings you closer to your ultimate financial independence. Stay positive, stay informed, and most importantly, stay the course. Your future self will thank you. Playing the long game, investing for the future. Investing is about the long game. We're talking years, even decades, not days or weeks. When you invest for the long term, short-term market fluctuations become less significant. Think of it like planting a tree. You wouldn't freak out if the tree swayed a little in the wind, would you? No, you'd give it time to grow strong roots. The same principle applies to investing. Ride out the short-term volatility. Focus on the long-term growth potential of your investments. One of the best ways to stay calm during market volatility is to have a solid emergency fund in place. This is your financial safety net. It's there to catch you if something unexpected happens. Job loss, medical emergency, car repairs, life throws curveballs. Having 3 to 6 months worth of living expenses saved can make all the difference. With a strong emergency fund, you won't feel pressured to sell your investments at a loss if you need cash quickly. This is crucial for weathering market storms. Section 6. Diversification. Don't put all your eggs in one basket. You've probably heard the saying, don't put all your eggs in one basket. This is especially true when it comes to investing. Diversification means spreading your money across different asset classes. Think stocks, bonds, real estate, and even alternative investments. By diversifying your portfolio, you're reducing your risk. If one investment performs poorly, others can help offset the losses. Section 7. Tuning out the noise. Staying focused on your goals. The financial news cycle can be overwhelming. It's a constant barrage of information, opinions, and predictions. It's easy to get caught up in the noise and lose sight of your own goals. Remember, you're not investing to beat the market or time every single up and down. You're investing to reach your financial goals. Tune out the noise. Focus on your long-term plan. Review your investments regularly, but don't make changes based on short-term market fluctuations. Section 8. Seeking expert advice. When to call a professional. Navigating market volatility can be challenging, especially if you're new to investing. Don't be afraid to seek help from a financial advisor. A good advisor can help you create a personalized investment plan, choose the right investments, and stay on track to reach your goals. Remember, you're not alone in this. There are experts who can help you make smart financial decisions. Section 9. Ride the waves. You've got this. Market volatility is a fact of life for investors. It's going to happen, but it doesn't have to derail your financial plans. By understanding the basics, staying calm, and focusing on the long term, you can ride the waves of market volatility and come out ahead. Remember, you've got this. Invest wisely, stay informed, and never stop learning.